Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian markets hit fresh record highs led by gains in metal and energy shares. All sectors barring IT trade in the green.
L&T rises the most in 9 months after the board says it will consider a share buyback on Thursday.
Infosys is the top loser on the Nifty after CFO MD Ranganathan makes a surprise exit.
The Met Department says intensity of rains will reduce over the next few days in Kerala, even as rescue operations go on in full swing to aid more than 7 lakh people who've been affected.
All right, all that coming up on the show, but first look at the markets. Neeraj is here, about 1% higher on the Sensex this afternoon.
Hey, afternoon guys, and yeah, doing very well. So, by the way, the Met Department also mentioned that the monsoon, which until the 27th or 30th of last month was erratic in central India, has now been stabilized and doing well. So, there's some positive news there as well. But yeah, strong gains for broader markets too in the session today. The Nifty's knocking on the doors of 350 points, about 1% higher, so very strong show. And the mid caps and the small caps haven't done too badly either. The market breadth is looking fairly positive, which is a good thing. I mean, 4 straight weeks of gains, and the indices are only building on from there. So the going seems to be very, very good. What's leading the charge? I think, firstly, the stocks in news. So L&T and Infosys at opposite ends of the spectrum today, with L&T up about 5-6%, with 6% higher now actually, because of this buyback news, and Infosys falling again because of news. But today's market is aided by a lot of gains to heavyweights. So ONGC and Reliance from the upstream space, both of them are doing well. The HDFC twins are doing well for themselves, by the way. HDFC Bank and HDFC, both of them are doing rather well for themselves in the session today. So that's what's giving the leg up to the index in the session today. A lot of heavyweights putting their weight behind percent and a half, 2% kind of gains, and all of these lead to about 0.7, 0.8% for the Nifty. The broader markets, again, peppered with gains to quality names, which are all trading at new highs. So 3M India, Page Industries, Britannia, that whole clutch of names are trading at new highs for themselves. The only sour spot, if you will, would be the stock of, or the list of companies which are under that ASM list. That whole ASM category stocks are falling apart today. So 3, 4, 5% downside for almost all of them. Well, quality, low quality doesn't matter. Almost everything is getting beaten. So that's one sour spot, but small pocket really. By and large, gains, volumes doing okay, volatility marginally higher. Not a bad day.
Not a bad day indeed. Neeraj, thank you for that. Let's talk about L&T. Larsen & Toubro is looking to reward its shareholders. The board will meet on the 23rd of August to consider a buyback. But analysts are not convinced that L&T has the balance sheet strength for it, at least at the current juncture. Yatin is here with the math of this buyback. Yatin.
Well, Harsha, as you mentioned, there is a board meet to consider buyback, and now what really the analyst community is thinking about is a couple of questions. Now, if you look at the balance sheet position for L&T on a consolidated basis, the secured and unsecured loans are close to 73,000 crores. However, on the other end, we have the current investments and cash at bank at nearly 16,200 crores. Those are the liquid funds sitting on the company's balance sheet. Close to $2 billion is what we can, put it. But if you look at the leverage ratios, the overall net debt to equity for the company stands at 1.74 times, and probably limiting their ability to do a very large sort of a buyback. And that is something that the analysts have been concerned about. But if you look at it from the management side, the stock has done nothing on a YTD basis, down 1%. Of course, this was Friday closing basis. So today's 6% gain would mean, the stock is up 5% YTD basis. However, if you look at the analyst take, they say that the probable buyback size could be 4,000 crores to 6,000 crores, taking into consideration that recently the kind of divestitures that they have seen at the subsidiary level and selling of non-core assets, probably that is the kind of money that the management would like to shell out at this point in time. However, the concerns are that given the fact that the first quarter guidance has been decent, the order inflow has been decent, the working capital requirements are expected to move up. So probably that will limit the kind of buyback size that the company and the market is speculating about, and also it may send a signal that the management feels that the payout generates better returns than the business itself. So that is something that the analysts are talking about. Now, we have done a scenario analysis as well as to how really the price will move up. If you look at a 10% premium to the current market price, which was Friday's close, the buyback price should be around 1,365, and if it were to be at 15% premium to the current market price, that would be around 1,426 crores. That is closer to the 52-week high. And of course, a chunk of these private sector fund managers, as well as PSUs like LIC, GIC, SUTI, all of them will benefit because a large portion of their holding is concentrated. For example, we have LIC, which is holding 18%, SUTI holds close to 2%, GIC holds 1.8%. So all of these funds probably would benefit. Of course, we have brokerages like CLSA which believe that a 4,500 crore estimated buyback would lead to a 85 basis points improvement in return on equity. They maintain a buy rating with a target price of 730. And there is one more interesting thing that CLSA has pointed out, which is that these will be the start of a series of buyback that the company might look at. And the kind of pipeline that they have shown for non-core assets divestiture is to the tune of $2 billion, and that could be the total size of buybacks that could come in the market soon.
All right, Yatin, thanks so much. So L&T is one headliner in trade today. Infosys is the other, this one on the downside. Infosys seems to be unable to get past its leadership troubles. This time, Chief Financial Officer MD Ranganathan has stepped down. The company's founder Narayan Murthy calls his departure an irreplaceable loss at a crucial juncture. Listen in.
Okay, that's the former CFO of Infosys. Let's talk about Bata. Bata India has surged over 20% in just a month to hit a lifetime high, and that's because the footwear maker has a lot going for it. Agam is standing by to tell us what's going on with Bata at this time.
Well, Harsha, comfortably above the mark of 1,000 rupees per share. Bata certainly has outperformed its peers, and if we can, take a look at the returns, we've seen Bata outperform the likes of Relaxo, Khadim, or Sri Leathers for that matter, not only on a one-month basis, but also on a year-to-date basis. It's well ahead of the rest of the pack. Now, let's take a look at some of those factors which have worked in favor of Bata. First and foremost, the push towards premiumization. Its focus from mass premium products to premium products, and that is something that has been working on and has been working on over the past couple of years, and realizations have been higher despite the fact that volumes have remained largely flattish last year around. Moving on, let's take a look at a few of the other variables too, and we do have a store expansion well in place for Bata, as it's opened around 82 new stores in the last financial year. That brings its total down to around 1,375. We spoke to the management, and the management once again suggests that they are looking to open anywhere between 700 to 200 stores in this particular year as well. We do have Bata, which has passed on the benefit of lower GST rates to its consumers, and that is something which has been working in its favor. Don't forget that just like many other industries, Bata is placed in an industry which stands to gain at the expense of the unorganized sector, considering we have GST implementation coming through. Well, it is also pushing quite substantially when it comes to its marketing spends, and in fact its ad spends rose by as much as 60% over the previous financial year, and of course it's also signing celebrities in order to endorse a lot of its products. That said, when it comes to its return ratios, well, reasonably higher than the 15% benchmark that a lot of analysts go with. So return on equity standing at 19% and return on capital at nearly 26%. Among the factors that which may not play out well for Bata, perhaps some few challenges. Well, it has seen flat volumes in the previous financial year, despite the fact that there has been a little bit of pickup in demand. That said, among other challenges, we also have transition from mass to premium. It is going to be something of a challenge considering Bata's identity has essentially been mass products, and considering it's moving up the value chain, well, we're going to have to wait and watch how it actually tries and maneuvers itself there. But when it comes to valuations, and this is perhaps where there will be another challenge for it to move higher up, considering it's trading at 59 times FY18. This is trailing price to earnings ratio, and the only competitor higher, more expensive than Bata is Relaxo Footwear, well ahead of the likes of Khadim, Sri Leathers, or Liberty Shoes for that matter. And that said, when it comes to your Bloomberg consensus analyst ratings, well, we do have about 8 out of 12 analysts who have a buy call on Bata, but its return potential is -16, which means that it perhaps has run well ahead of its current fundamentals, and which is why we could expect some consolidation, if not a price correction on Bata India. But on the whole, analysts remain positive, largely on the opportunities that the company provides.
Interesting, Tarakam. Thank you so much for joining us with those details. That's Bata India for you, trading at a life high. Let's move on. The government has distanced itself from the backdated GDP data put out by the National Statistical Commission. It claims that the numbers are not official estimates, as the calculations are still work in progress. The revised numbers, which are based on the 2011-12 as the base year, show that the Indian economy grew in double digits in 2007-8 and then in 2010-11. Ira is standing by to take us through some of those key highlights of that data. Ira.
All right, this is a story which starts with economics and ends up in politics. We'll try and cover both sides of it, but mostly the economics. In case you missed out, Friday we got a report. Actually, the report came out earlier in July, but it sort of surfaced on Friday, which was giving you the back series on the current GDP data. If you remember, there's been a whole lot of debate around whether the current GDP series is comparable with the old GDP series, and that debate sort of got put to rest when this estimate from the National Statistical Commission came out. Two things before we get into the growth rates. The one thing that comes out is that directionally both the old series and the new series are fairly similar, and there was a fear that the difference between the old series and the new series could be as high as a percentage point. Some were fearing almost 2 percentage points. It isn't that wide. There is a slight upside on the new series, but it's an average of about 40 basis points. So the fear that the two series were not comparable at all has been put to rest going by this particular series. Here we are taking the market price at constant price GDP growth. You can also look at it on a GVA basis, but this is the GDP growth numbers on a market price constant price basis, and that's telling you that directionally the two series are similar, slight upside of about 40 odd basis points in the new series. Now that's the point that was made out in the report as well. So if you look at the key takeaway from the report, they talk about the fact that the series are comparable. Difference between the growth rates in the old series with the 04-05 base rate and the 11-12 base rate has minimal differences, they said, and that's largely due to what they call the discrepancy variable, which is found to be highly volatile. That was in the National Statistical Commission report. Now, obviously, the data took a political turn over the weekend with the UPA arguing that the highest growth rates for the economy had been hit during their rule, and the NDA arguing otherwise. So you had over the weekend, the Statistics Ministry coming out and saying that the methodology has not been finalized yet. There are various ways of backdating the data, and this is one way. So they haven't put their official stamp on this data. But should you go with this data, there are other economic takeaways. I think one thing that a lot of economists are pointing out is that, yes, there is GDP growth, which always headlines the economy, but there are other aspects of the economy to take into account, and some of those are worth noting. So, for instance, if you look at the 10-11 period, which is when at least GDP market prices, constant prices growth was at about 10.78%, this was a period where you also had very high inflation. I've taken the IMF average CPI because that gives you a consistent series. That CPI was at about 9.5%. You had a current account deficit of about 2.8%. In the year after that, you had a current account deficit of 4.2%. So some of those imbalances were showing up in other economic indicators, is the simple point I'm making. And most importantly, the fiscal deficit that year was 4.9%. The year before that was 6.5%. So it was the post-global financial crisis stimulus that was thrown in on the fiscal and the monetary side, which probably led to this growth, which also led to a very high inflationary period, and we know what happened after that. If you look at the other year in which you had double-digit growth, this was 7-8. Again, GDP growth, market prices, constant prices at 10.23%. In that year, IMF average CPI was at 9.1%. The current account deficit was at 1.3%, went on to about 2.3% in 08-09. Fiscal deficit was, relatively contained at 2.5, 3.3. This was a period which was a global story just before the global crisis. Global growth, perhaps, lifting all other economies along with it. How does those periods of growth compare to where we are now? Well, remember that in the current year, you're expecting growth of about 7.4%. That is going by the RBI's estimate. The IMF expects inflation in the year at sub 5%, 4.9. Current account deficit has been widening at 2.5 to 2.8% is the expectation, and the fiscal deficit is at 3.3. The simple point we are making, or at least the question we are asking, is that is GDP growth a celebration in itself, or should it be put together with other economic variables to understand what was the most sustainable sort of situation for the Indian economy?
Thanks for that. Let's pose that question to our guest today, Arvind Virmani, former Chief Economic Advisor to the Government of India, President of the Forum for Strategic Initiative and Chintan. Mr. Virmani, thank you so much for joining us on Bloomberg Quint. Firstly, what is your assessment of this backdated GDP series on two counts? One is, did it really represent the growth of the previous decade? Do the new numbers truly represent the growth of the new decade? Let's start with your initial observations first.
So, over the last year, I was talking to people in the Department of Statistics, the statistical people, and I had heard that they had this thing, but they were not sure for two reasons. One was that the MCI series actually starts in 96, 97, which has formed an important base for the 2011 12 series, the new series. And secondly, there was a change in the MCI approach from a couple of years later, I don't remember exactly, but 98 or 99, they changed it. So my general impression before this series came out, that the back series till around 99 or 2000 would be relatively easy to do, but going beyond it backwards would be a little difficult. So there is a issue there, but let's take that as given for the time being and discuss the series. Now clearly it makes it easier for us, for me as an economist, to do two things. One is it helps, even though the series is not perfect, it helps me look forward and make estimates of the potential GDP of the economy, because without the back series that becomes very difficult. You can't do it on the basis of 7-8 data points. You need at least 15 or 20 to be able to make judgments about the future. That is one aspect. And the second thing is that I wouldn't really put too much emphasis on the exact year-to-year ratio. So I generally growth rates. So I basically look at it more from the medium long-term perspective, which is at least I take a kind of 7-year, 10-year averages to look at long-term growth trends. So these are the two preliminary points I would make.
Okay, Dr. Virmani, I'll come to the potential growth rate and what you make of it based on this series. But let me first, sort of get the political economy debate out of the way a little bit as well. Even if one looks at it point to point, is it not fair to say that one has to, bring together other economic variables in the years that we are talking about, or in the years before that, the years after that, to understand what led to the growth and what that growth led to?
Right. Yeah. So again, we have 2 points here. One is that again, from my perspective, looking at growth, I look at reforms and the connection of reforms to growth. So clearly, there are lags to growth, as I've shown in many of my papers, as something I call the J curves of reform, growth and productivity. That if you have major reforms like we've had in the 90s, there's always a lag to seeing that translate into a growth acceleration. And what I pointed out in this J-curve paper, which is also an IMF working paper, is that you can actually get a slight decline in growth if you do major reforms. So that is one point, the lag between reforms and when you see the growth. And your second point is also correct. You can have, the way we look at it in growth theory is sustainable growth versus bubbles, right? So the point you made is exactly correct. I have argued this for a long time, not just with the new data, but with the old data, was that 2010, 2011, you know, I was a CA till the end of 2009, and I had very clearly made clear to everybody who would listen is that we need a stimulus to recover from the global financial crisis, but as soon as growth rate goes back anywhere near you know, the 7-8%, we must reverse this stimulus. Now unfortunately that did not happen in 2010-11, and therefore I consider that 10% in that year actually as part of the bubble, which subsequently gave you all kinds of problems. You have correctly pointed out that inflation went up, etc., the fiscal deficit, the current account deficit. Because that was an unsustainable bubble, we would obviously discount it, and we would look at the other macro factors, as you correctly pointed out.
Dr. Virmani, do these new numbers, at least the presence of a backdated GDP number, make you change your mind or review what the government back then did during the years 2010-11 and the policy response that happened during that time? Would you change your mind at all about what was done at that juncture?
No, I don't think I changed my mind on either of the 2 points I made. I've been making these points since 2010-11. Both the macro unsustainability point and the growth. I actually remember an interview I gave before I left in October 2009, where I clearly pointed these out. I think it was to some southern newspaper or TV. I don't remember the exact thing, but I remember saying this, that if you want sustained growth, we must step up the pace of reforms and reverse the stimulus which we had given. The stimulus was very valid when your growth collapses. I don't think people remember how bad the global financial crisis was, and it was a big negative shock which could have taken us down to zero or negative growth. So that stimulus at that point was absolutely essential, and I think the numbers, I don't remember exactly, I think it went, even despite the stimulus, the 2008-9 growth went down to roughly 2-3%, I think it is. So the stimulus was very necessary in 2009, but we then recovered fairly quickly, and then that was the point to reverse it. And I had made this point in an interview. Of course, internally I had been saying it to people. I was leaving, so I had no influence on the policy after that, but I did make it clear to the to the concerned people, I don't want to mention individuals, that this should be done if the growth recovers.
Dr. Virmani, the
and
other
they didn't
point
do
you
it.
made in your
I mean, they actually, there was, yeah.
No, sorry, please complete your thought.
Yeah. Right. So in fact, they did the reverse, because there was a windfall gain from spectrum auctions in 2010. And not only did they not use it to reduce the fiscal deficit, they actually spent more than that extra amount. So in some sense, it was the reverse of what one had recommended when one left.
Dr. Virmani, I was going to go back to one of the points you made in your initial comments, and that is on what this series now tells us about potential growth for the economy. What is your judgment? Would you still say that potential growth for the Indian economy is in the early 7s, up to about 7.5 perhaps? And in that sense, given the current year's projected growth rate, we are, well, fairly close to potential.
Right. So here is how I would analyze that. I mean, before the new series came, I have a paper which was presented at OECD, which basically put the potential growth rate of the Indian economy at that point at between 8 and 8.5%. Now, since the global financial crisis, the question becomes, how much has the global environment worsened compared to the pre-GFC period? And my guess would be between 0.5 and 0.1%. So in that sense, the potential may have gone down by at 0.5% to 1% from what I had earlier estimated. The new data kind of confirms that, but I believe that if the pace of reform, which has now accelerated in my view from the previous 10 years, is continued into the next 5 to 10 years, you don't have to do huge big bang reforms. I think people have this mistaken notion that big bang is what works. No, you have to keep at it. So if they keep at this pace of reform which we have seen in the last 4 or 5 years, then I believe that you can get close to that old level of 8 to 8.5% despite the worsened global environment.
Okay, Mr. Virmani, if I can bring you to the data points of today, for instance, two aspects. One is CAD that is widened significantly, and this is not just oil imports, even non-oil imports like gold has widened significantly. Is that a cause of concern? And secondly, the unprecedented fall that we've seen in the rupee. It may have retraced some lost ground today, but are these signals of alarm for you, or do you think this is par for the course?
Yeah, right. So that's an excellent question, because very different people have different views, and I think it's very important for my view to be on the table. What I have seen in my 20 years or more in government is that whenever things become good, people forget the importance of fiscal control. That's why the last 4 years I have consistently said that we must keep on the trend to fiscal deficit. And also we have forgotten the revenue deficit. In my last economic survey in 2009, I actually laid out a 10-year suggestion to reduce the fiscal deficit to zero and the revenue deficit. Now, people have forgotten the importance of revenue deficit. So let me very quickly explain. The revenue deficit is approximately equal to the net dis savings of the government. And the net dis savings is very important for both our credit rating, the external imbalance, the amount of capital inflows we need, the current account, and many other things, related things. So I would reiterate, despite Mr. N.K. Singh is a friend and an old colleague of mine, or my old boss, but I disagree with his committee report. That committee decided that revenue deficit is not important. I still believe it's important, and the reason I've just outlined to you. So to directly come to your question, yes, there is a risk, and we must stay on that trend of reducing fiscal and revenue deficit if we want to reduce the risk. And the risk is now rising. This is the problem. So if the more you reduce the fiscal deficit in good times, the more insurance you have in bad times. And it becomes more and more difficult when the external environment becomes bad to reduce it then. So, this is one of those long-term things which only old people like me remember, because one has been through many, many such crises over the time I have been in government.
Not old, Dr. Virmani, experienced. Lovely to have had you here on the show. Thanks so much for all your views, both on the debate on the new series, plus also on the current economic situation.
All right, let's move on and let's talk about Kerala. Now, Kerala has received nearly 3 times its normal rainfall this month, causing the worst floods in a century. The disaster has taken at least 370 lives and left more than 7 lakh people displaced. Rain gods have finally relented. Monsoons are not yet over, but the Met Department expects the intensity to drop considerably in the next few days. Operations at the Kochi International Airport remain suspended, but the first commercial airplane landed in the city's naval air station this morning. Meanwhile, rescue operations are continuing in full force. There are currently over 1,500 relief camps operational in the state. The Quint's Rohit Nair sent us this report from Ernakulam district just a short while ago.
The situation in Kerala right now is improving. The water levels have receded significantly. The rains too have ceased. Although the death toll is quite high, it's about 350. Things are looking quite bright in rescue and relief camps. I had visited the relief camp yesterday in Kochi University, where 4,000 people are housed. The Navy is also over there, and they are providing people with surplus food and clothing along with other medical requirements. Right now I am at a place called Muvatipura in Ernakulam district. What you see behind me is a shelter home for dogs, and the owners of the home and the dogs endured the floods for 5 days. The water had rose up to over 14 feet, and the owners of the shelter cooped up with the dogs on the roof and survived nature's fury. such kind of stories are coming out of Kerala. There are many such positive stories where the youngsters, especially school and college going children, are out there on the streets volunteering for flood relief. I have traveled with them from Ernakulam, where an NDRF base was located. I went out with them distributing food and relief packets wherever relief camps were set up across the state. As of now, things are looking bright. The spirit of Kerala endures, but the rebuilding and rehabilitation process over here will still take a lot of time.
It will take months for Kerala to rebuild itself, and the effort will need 1 million hands. Here are some of the ways in which you can contribute to the rescue and relief efforts.
Let's move on. The Indian contingent opened their account on the inaugural day of the Asian Games in Jakarta, with the Indian shooters putting up a good show on day 2. Deepak Kumar won the silver medal in the 10-meter shooting category, while Apurvi Chandela and Ravi Kumar bagged bronze in the 10-meter mixed team event. India's first gold was won by 25-year-old wrestler Bajrang Punia in the 65 kilogram category in the men's freestyle event. However, twin Olympic medalist wrestler Sushil Kumar was knocked out in the first round of the 75 kilo category.
That's a wrap on this edition of Parnage. Thanks for watching.
Let's talk more coming up on Bloomberg Quint. Stay tuned.